I'm going to go hit record. And so we're going to finish up on current liabilities. I'll take a couple of survey questions and attendance questions, and I'll go over and share my screen and take a look at the opportunities that we have to, let me share the sound as well. That would be helpful. And again, if you have extra credit, make sure to either let me know when I ask at the beginning of class, or if I neglect to, remind me at the beginning of class, because again, I want to make sure you have the ability to participate, take advantage of it, earn it, and be on our way. Most of the stuff we'll see here is probably a review, but I think it's good to reinforce, but I will be asking you the value shortly as well. So let's go ahead and talk more about current liabilities. We'll be emphasizing long-term liabilities in the next chapter starting Monday. We'll get into bonds, which are more of a long-term loan, but here we'll emphasize the current liabilities. So I'll go ahead and move forward.
I'm doing well. Boss. About to tell me I always say good beforehand, so I made it grammatically correct. I'm doing well today, boss.
I just wanted you to say something different.
Well, not good. That's
Whatever
good.
you wanted to
Mission
say was fine.
accomplished.
Mission accomplished. So, all right. Well, today we're going to be getting into liabilities, and we're going to touch on present value a little bit.
Jumping on the other side of the balance sheet. I like it.
Yeah, that's true. It's a good point. We're done with the assets now. Now we got liabilities and owner's equity left. When we start with a high level here, liabilities are going to be different for each company and especially by each type of industry. So if we look at Walgreens, first off, drugstore, Walgreens and CVS, the two big drugstores in America.
Retailers, yeah.
Retailers, do you prefer one versus the other?
I'm a Walgreens guy, but that's just because there weren't any CVS. This is where I grew up. What about you?
I was always a Walgreens guy, but now I got a buddy who works at CVS, so that's where I go now. So.
CVS proud, huh?
That's CVS proud. So,
but what do they got for liabilities?
What do they have?
What do they show?
Yeah, so they're a retailer, so they're going to be purchasing a lot of supplies from folks that are making the drugs and other supplies that way, like a Johnson & Johnson, Pfizer, companies like that. So we're going to expect very large accounts payable for a retailer.
Hey, we see that. Right? It's almost their biggest liability that they have on there.
Yeah, absolutely. So you said almost their biggest liability.
Oh, sorry. I guess it is the biggest liability.
Last year it was second place to long-term debt. So, but then they also have a lot of long-term debt. All the stores that they keep opening up, they got to finance them.
That's a tremendous amount of turnover, though.
Walgreens in every corner.
Payable, right? All the drugs. But that balance is greater than their long-term debt amount, and they're paying that off. It's in the current section. So they're going to be paying that off within a year.
Yeah. So this is in billions too. So they got to pay off $13 billion to suppliers over the next year here. Now let's compare it a little bit differently for a manufacturer. And I went for a manufacturer here that is makes a lot of long-term assets. So Boeing.
Are you Boeing or an Airbus guy?
Definitely Boeing. There was a very senior guy there that is a Johnny and at our school, and he actually gave me my first ever corporate job.
That's cool.
Highly biased toward Boeing. So because of that,
we don't really have a choice as consumers, though.
That's true. That's well. Okay.
I guess you could refuse to fly certain airlines that aren't using Boeing-made aircraft.
That's true.
We digress.
We do digress.
That's my bad. Sorry, everybody.
It's okay, but it's okay, Ben. You can see that Boeing has a similar amount of accounts payable that they're paying for their suppliers. They've got a lot of raw materials in the planes. They got $12 billion of accounts payable. Walgreens had $13 billion, but then they have a lot larger accrued liabilities. And one to point out right here is advances in billings in excess of related costs. So you have any guesses what that one is, Ben?
Seems like a fancy way of saying unearned revenue.
You nailed it, man. We didn't even talk about that in advance, and you got it. And another big thing Boeing has is a huge amount for accrued retiree healthcare and then pension plan liabilities. And we're going to get to what those are in a little bit.
And so, yeah, one thing I like to point out here, two different companies, they have a lot of very different liabilities. And so there's not going to be a bunch of consistency necessary that every company shows the same liabilities. There'll be some overlap, certainly, but it just really depends on different companies. And that's going to set the tone a little bit for the ones that we go through here today.
Absolutely. So, well, the overview, what we're going to get into, we're going to understand how to account for liabilities. And we're also going to get into some future value topics and some present value topics. Well, hopping right into it, current versus long-term liabilities. We covered this kind of stuff actually back in lesson 2.
What do they call it? A throwback. We're doing a throwback.
It's a throwback, but we're recording this on a Monday. So throwback Monday.
Watch it on a Thursday. It's throwback Thursday.
That's right. Current liabilities are those expected to be paid off within current assets. And Ben, when you think current assets, you think?
Within a year.
Boom. Good job, man.
Technically, it's a year operating cycle.
Yeah, it is. So
I think a year.
Yep.
It's pretty much the standard.
That's what I say for simplicity. Most creditors expect to be paid off within a year. Thus, the majority of liabilities are current. Well, at least that's what we saw with Walgreens there. Boeing had some pretty long-term stuff with pensions and healthcare. I think that's more the exception than the rule then.
Yeah, I would say some of those long-term ones, just in general, they might be bigger amounts, but there's fewer of them.
That's a good point.
A big loan or a big couple of loans are going to take multiple years.
Yeah, like if you looked at a company's trial balance, they will probably have dozens of accounts for current liabilities and then just a handful for long-term liabilities, but they'll usually be big amounts. And then those are going to be loans, bonds, leases, pensions, deferred taxes, all items, which we'll get to in a little bit.
I can't wait.
Okay, so let's just start going through them. So most companies have an accounts payable. I think of those as items that are purchased but not paid for right away with cash. So we oftentimes will say that they are purchased on account. They're generally paid off within 30 days. They're not interest bearing. What do you think, Ben? 30 days? You agree with that? Or?
Just from my experience as an auditor, there's a lot of companies that go longer than 30 days where say you're, like a Walmart, something like that, or a Target, where you're probably going to be a pretty big vendor or pretty big customer for whoever that vendor is. They might be able to negotiate 60 days or 45 days or things like that. But generally 30 days is the starting point if you can get credit at all.
That's a good point. Most often when company purchases inventory, supplies, services, we saw a huge amount of accounts payable for Walgreens. That's when they're buying their inventories for their shelves. So let's take this example. Walgreens purchased purchases $1,000 of medicine from Johnson & Johnson. It'll make payment next month. So what do you think, Ben? Debits and credits on this one?
Yeah, so when they
Can you
buy
do
it, that medicine's going to be the inventory for them. I think I can handle it.
All right.
So debit inventory for $1,000. They're not paying right now. They're going to pay later, which means we got that payable. So we're going to credit accounts payable.
How about when you pay it off later?
Well, that's when cash is going out, unfortunately. So I'm going to debit my accounts payable and credit my cash account. And you can see net here. We have a credit to accounts payable, a debit to accounts payable. That one's going to be eliminated. It's turned over. And what's left is we had increased our inventory and cash has gone down.
At the end of the day.
At the end of the day.
We got inventory and we're out cash.
Well, at the end of the day, hopefully we sell
We're
the
out the
inventory and we get more
inventory.
cash.
That's true.
That's the goal, but
That's true.
we're not there yet.
All right. Accrued expenses and liabilities. They're recorded when a company receives services or supplies by the end of the period, but doesn't pay for them until the next period. Oftentimes
Then the
used with
accruals.
estimates for a bill that has not yet been received. So we talked in lesson 4 about adjusting entries. That's what a
Estimates,
lot of these
accruals,
get recorded.
saying-
We're trying to match expenses with our financial statement income.
Yeah, so here it'd be a lot easier, wouldn't it, to just, well, we got a bill, so I'm going to record it as an expense at that time, but that wouldn't really be right. It'd avoid our matching principle that we talked about, matching expenses to revenue. So at the end of the year, we got to look at everything. What potential expenses could we have incurred that we haven't yet received a bill for, or that we haven't paid for yet? And then based on that, we're able to record our expense and liability and also match our expenses with the income.
Exactly.
So life is good, man.
Yep, exactly. So like Walgreens, they use electricity during the month of September. Let's say it's $2,000. They're not even going to get a bill until next month now, but the fact is they use that electricity in September. So what would you debit and credit on this one?
So for this one, some sort of expense that covers electric, usually it's called utilities expense, would be debited, and then I would credit utilities payable.
Right.
And then when I actually paid off, just like the one before, I'm going to debit the payable, credit the cash for $2,000, and now everything's good. Recorded the expense in the proper period, and doesn't mean we have to pay earlier just because we recorded it earlier. Still the same due date, but now our
And you'll notice that's utilities payable, not accounts payable or trade payables. So trade payables are vendors that you get stuff from. Now, yes, you're getting utility or electricity from a vendor, but it's not trade type stuff that you're going to resell or use in the stuff you make. So the utilities payable is a separate kind of payable, as would be employees payable, as would be other payable type items and not considered accounts payable.
financial statements will be accurate.
All right. Income taxes payable.
I'm gonna let you do that. You're doing all of them. I'll let you do this one for sure.
I am the tax guy. So tax expense, you want to record it when a company earns the income and not when the cash is actually paid to the government. Those can be very different, and that's beyond the scope of this PowerPoint, but you can learn about that more in a tax course. So let's say that Walgreens earned pre-tax income of $6 billion in its most recent fiscal year. That is actually true, and then the new corporate tax rate is 21%. The debit in that one, you would multiply those together and debit income tax expense for the $1.26 billion, credit the income taxes payable, and then when you actually paid off those taxes, then you would debit the payable and credit the cash. And again, we're recording the expense in the period, matching it against the income regardless of when cash is paid.
Back to the matching
Notes,
principle.
Pat
Key.
and Boss.
That's pretty much it. The first entry, an expense and a payable. The second one gets rid of the payable and also gets rid of your cash.
Cool. Let's see if it holds true for compensation.
I think it's going to. So, but
I think so too.
Yep. But so compensation. So companies record compensation expense in the period when it was earned. So really, when do the employees earn the compensation from the company?
Yeah, this happens, and we're going to see it on the next bullet point here. It happens at year end all the time. Companies have to make an estimate. What do they owe their employees at year end? If the day that they actually make their next payroll isn't the same day as year end. There's going to be some sort of gap, usually, where companies still owe their employees money.
So I think like at our college, we get paid twice a month on the 15th and the end of the month. So we don't have the situation where we've worked and they pay us the next month. But a lot of
for salaried employees. But what about, I guess, even hourly too, if they don't work at all.
Yep,
They get paid on the 31st. But
a lot of businesses, they just pay every 2 weeks. So they might pay on December 27th, and then maybe people work a few days, but they won't get paid until early January then.
Or even if it is hourly employees and maybe your payroll is like a week behind the hours that report for when you turn in your time card, give the payroll people some time to calculate everything, where you could have worked something. Even if you do get paid December 31st, you might have an accrual for the work in the last week.
Exactly. So let's say you got a worker who earns $200 a day, and by December 31st, they haven't been paid for 5 days of work. Maybe they've also earned a couple days of vacation pay. They also earned a vacation. Yeah, that's nice.
Vacation.
Remember, I got my first paid vacation. That's awesome. So, and then maybe a $150 bonus. Well, what the concept is here is even if you're not going to pay these amounts until January, you want to debit all the expenses in December, in this period. So the 5 days of wages, the bonus, the 2 days of vacation, and then we need to credit some account. If we're not going.
And again, like the last class we talked about it, vacation is an accrual. So you have to record vacation expense and vacation payable or pay.
To actually
wages
pay the cash,
payable.
we don't want to credit cash. We want to credit just some sort of payable account here. And then we jump ahead to January when we actually will then pay our employees, or maybe they take their vacation. Then this is very simplistic. They might not take the vacation until later, but the simplistic way when we no longer have an obligation to them is when we debit the payable and then credit the cash.
Yeah, and so this one, I'm just going to expand a little bit on the bonus expense. And the way that I've seen this done is that at the end of the year, the executives basically the entire company, they make an accrual for what they think the bonus is going to be, but that's not official until the board of directors actually approves that bonus amount. And so this is a pretty big guess for people to figure out what is that bonus expense, but at the same time, it's for everything that was done in the previous year. So you're not able to just, oh, we'll wait until the board approves it. You have to make some sort of bonus accrual.
You can reasonably estimate it. So
in the previous year.
That's great insight, man. Appreciate that.
Yeah, I went through that. It was actually a big deal. One of my clients.
Oh, nice, nice. Well, payroll taxes, this is kind of a newer topic. A lot of these other topics we've been through before in the previous lessons, but payroll taxes is newer. And what the concept is that employees have certain deductions that need to be withheld from their paychecks. Payroll taxes is one of those. Social Security taxes, the first 6.2% of your wages you have to have withheld and remitted to the government for Social Security taxes. Medicare is 1.45% on that. There's no cap on Medicare. Social Security is taxed, is withheld on the first 128,400 of your income. Medicare, there's no cap. And then the employer must match those amounts as well. And we're going to show you an example coming up about how that works. There's also federal and state income taxes withheld, health insurance, retirement savings. What else do you have taken out of your checks? So dental.
Dental, I guess.
Could have some
Vision
charity
insurance
taken out.
sometimes. Oh, yeah, a lot of companies will do charity if you're donating.
Disability.
I was just wondering, are you getting excited about payroll taxes?
Do I get excited
Yeah,
about
because
them?
you're more of a federal tax guy,
I don't
like
get too
international
excited
tax,
about
right?
it. So,
Okay.
do you get excited about them? You can do this one if you want.
No, I do not get excited about it. Do you get excited about that coming out of your payroll?
Not really. So payroll taxes. Let's say an employee earns $1,000. The employer's got to withhold payroll taxes, $100 of federal income taxes, $50 of state, $85 of health insurance.
That is a lot to keep track of.
It definitely is, and that's just what happens. That's why companies have payroll departments.
Yeah, a lot of companies outsource payroll to someone who can keep track of all these different laws and everything.
By the way, if you're an entrepreneur and you start having employees, I often encourage my clients and colleagues to take a service bureau, hire somebody to do the payroll, because I'll tell you, the first time you get hit for a penalty from the IRS for late payments of payroll taxes, or you have to hassle to collect the calculation and you miscalculate and you misfile, it gets into some heavy bucks. So be aware that you want to be careful with payroll taxes. You want to pay them on time. You want to pay them accurately. And if you're not real good at it, it may pay not necessarily to hire it out to your accountant, but to hire it out to a third-party payroll service bureau to handle the tracking. They'll take care of making the payments, doing the filings. And if there's a mistake, that's their fault. They're on the hook for it. So it's not, payroll service bureaus are not a bad idea, especially for newer companies or established companies. You don't want to worry about the IRS breathing down your neck.
And they'll be the ones who actually do all the
That's right.
recommendations. So.
Exactly. So what you would do is you would have gross wages of $1,000 for the employee. Then you take out Social Security taxes. That's 6.2% of the 1,000.
That's good mental math.
I appreciate that. So you take out Medicare, 1.45% of the 1,000. Now you got the federal income taxes, the state income taxes, the health insurance premiums, and then they would only take home $688. So that's very real. That especially once you start to get your first full-time job and have to have health insurance taken out and make enough money that income taxes apply. Your take-home pay is a lot less than gross wages.
When you were creating this example, Boz, did you try and choose a reasonable federal tax rate and state income tax rate? If you were to annualize the gross wages of a grand
I tried to
over
choose
here?
something that was half reasonable. Yes,
That's a tax guy for sure.
That's a tax guy.
But it's good for you guys to see this too, even outside the accounting side.
Ooh, all right, well, appreciate it. So
good work, Boz.
That's right. Well, the journal entries on this one, why don't you take us through
Yeah,
these?
so as a company, we are first going to start by debiting our wages expense, because that is what our company is going to end up paying. Not the same that you're going to get as an employee, but still what we have to pay. We're going to do a credit to payroll taxes withheld and payable.
The expense and the
Social Security
payable.
And Medicare. Just combining them
Payables are
together.
going to go on the
Have a
balance
credit
sheet.
to income taxes withheld and payable for the state and federal amounts. Credit to health insurance withheld and payable for 85,
payable.
and then credit to cash for the 688.50. So what you'll see here is that this cash piece that you're looking at, that's what the employer or the employee actually gets. These amounts are withheld on behalf of the employee, and then we are going to have to pay that out. If we're the employer, we're going to pay that out to the insurance company or the federal government or the state government, just depending on what it is. So additionally to that, the Social Security and Medicare is a matching
As I
tax.
said on the previous slide, they've got to match this. So this is an additional cost to the employer.
Exactly. So not only does the employee kick in $76.50, the employer also kicks in $76.50.
And then
where we have
SUTA
a debit
and
to payroll
FUTA,
tax expense
state
and then credit
unemployment,
to payroll
federal
taxes
employment.
payable. Whew, that's a lot. It's a lot in just one entry, but hopefully by looking at the previous slide, you can see it's not so bad to calculate everything, and then it's really mostly just adding the word payable at the end of it. So total expense for the company then, the $1,000 that they pay in gross wages plus the $76.50, which is their
Plus
matching
some other
portion of
benefits,
Social Security
actually,
and Medicare.
usually.
All right. So now when we actually pay it off, on the other hand, we are going to debit all those payables that we had established, debit payroll taxes withheld and payable, debit income taxes withheld and payable, debit health insurance withheld and payable, debit payroll taxes payable, and credit cash. And so really with our payroll taxes entry, or I guess our payroll entry, we have the initial one where we credit cash what goes to the employee. And then after we accumulate that over the course of a month or a quarter or whatever it is, we make this entry, which shows all those amounts that we were withholding on behalf of the employee and that we had to kick in, we remit to the health insurance company or the government.
Yeah, so the total amount of cash the company pays out is, in this case, it'd be $1,076.50. The $1,000 to the employee, and then the extra, or excuse me, the $1,000 that the employee earned, and then the extra $76.50 they had to match. All right, unearned and deferred revenues. Again, we covered this one before, just as in previous lessons.
Throwback.
Simple refresher. When a company receives cash before it delivers goods or provides services, it has to set up what I refer to as a temporary liability account because they have an obligation to do something, deliver goods or provide services. So let's say Boeing gets $100 million from Delta for a Boeing 737 plane to be delivered next year. This is way too simplistic, but we'll just run with it.
Gets us started, right? They're going to be happy. They're going to debit cash for $100 million, and they're going to credit unearned revenues. And then once they actually do deliver the plane, build it, do everything in the next year, they're going to debit unearned revenues and credit revenues.
All right.
And they'll be done.
Yep. Accrued warranties, we didn't really touch on those too much before, but what that is many companies offer warranties on products they sell. If the product is defective, the company will fix or replace it, and then usually have a cash expenditure to do so. But you need to record warranty expense at the time of the sale, not when the warranty claim is made.
We talked about Xboxes
have an
last
expense
time.
related to the warranty because you
Microsoft.
sold a product. So we want to match up that anticipated expense with
It's that
sale.
same matching expense we were talking about
Matching
early with
principle.
accruals. Yep.
Yeah. So we'll just, an example with Toyota, they provide limited warranties whenever they sell a vehicle. So let's say every time they sell a Camry, they estimate a warranty cost of $800. So at the time of the sale, they would
Debit their warranty expense for $800, credit accrued warranties for $800, thinking, okay, I'm gonna have to pay that at some point. I don't know when, but at some point, this could be either long-term or short-term.
Yep.
And then they're gonna go ahead and debit accrued warranties and credit cash for the $800 when they do actually have to make a payment under that warranty.
And we say making a payment, I mean, that might be when someone takes the Toyota car to a dealership and they actually have to, then Toyota corporate has to pay the dealership in order to fix that part on the car. So,
Very realistic example.
well, thank you. So the short-term debt, or it's sometimes called current portion of long-term debt, companies frequently borrow funds with payments due more than 1 year away, so that we initially record them as long-term debt. But then when that long-term debt suddenly is going to become due in less than a year, we need to reclassify it as current. And then let's say an example here, Walgreens borrows $2 million on a 5-year loan to construct a new store.
All right, so when they first borrow the money, they're going to go ahead and debit cash for $2 million, and then they're going to credit their long-term debt for $2 million, because at that time, it is long-term, right? It's 5 years away that they have to pay it.
Yep.
Now, let's say 4 years have gone by.
Like for the next 3 or 4 years, nothing changes, right?
No,
So you
they
made that
split it
entry and
there.
it just sits there for a few years. Sorry, I interrupted you.
No, that was the right thing to
Back
do.
at you, sir.
All right, so let's
Appreciate
say now we are, in year 5, and it's going to come due in a few months. So what they're going to do is debit long-term debt and credit the current portion of long-term debt. They're not paying it off right now. They're just reclassifying it on their balance sheet so that investors know, oh, that's current. They're going to have to pay $2 million in.
Now, they do have to pay interest right along with that every 6 months usually. And also, I'm going to make a variation here. We talk about more like this in financial reporting, but if the intention of Walgreens is to refinance this $2 million, they don't have to put it in current portion of long-term debt. If it's 1 year or less, it's due. Technically, you say, yeah, that's a current liability. That makes sense. I'm going to move it from long-term to current. But the reality is, and the gap says that if the intention is to refinance that debt, if you got a 20-year bond issue and you're in year 19, and you intend to refinance that 20-year bond with another 10, 15, 20-year bond, you can keep it as a long-term. So intentions often determine how you treat things. So again, you want to be aware of that. The other part of this, we talked about a mortgage, a 15-year or a 30-year mortgage. The next year's principal is the current portion of long-term debt. So let's say 15-year mortgage, the first year, you're going to have 1 year worth of principal as current and 14 years long-term. Next year, you're going to have 1 year current, but 13 years of long-term debt left over. So there's a current portion of long-term debt when you're paying off principal and interest on a monthly payment situation on a borrowing.
Within the next year.
Yeah. And if investors can look at that, and if the company has no way to pay that off, that could be a risk. The company might go through bankruptcy or something. So that's why investors need to know the current portion.
Absolutely. And so next up, we have leases of fixed
I'll let
assets.
you handle this one.
Yes,
Yeah.
please do. There's some new lease accounting
New lease
standards that
accounting,
have come out. And so this one, I guess leases could be either short-term or long-term. And depending on if it's a long-term or short-term lease, that depends on how you treat the accounting as far as recognizing a liability versus an expense. So in this first case, let's just say we have a short-term lease. If it's short-term, it's going to be classified as operating lease, meaning just each year you record an expense. If you have a lease and it expires at the end of the year, then you just record lease expense or rent expense for the year and you're done. Credit your cash, you don't have to worry about it. If it's longer term, so greater than a year, it's going to be accounted for as a fixed asset, meaning you're going to debit an account called leased assets or leased equipment or something like that, and then you go ahead and credit lease payable. And that's going to, over time, it's going to reduce, and it is pretty complicated. We're oversimplifying right now, but what I want you to know about this is if you have a long-term lease, you should capitalize that on your balance sheet and create an account called lease payable. So you'll learn more about this in your intermediate accounting courses. You don't have to worry about it right now, but just the baseline is what we want you to get out of it. How'd I do?
I don't know. I took a nap for a minute. So,
Took a nap, so it was riveting, huh?
It was riveting. I'll let you talk about leases. So it's all I can do to keep up with the new tax law. I'll let you keep up with the new lease standards.
The new everything else?
The new everything
That sounds
else.
great.
That's
But
right.
I'll do tax, I'll do everything else.
That's right. I'll talk about contingent liabilities. I like these because I've been studying one company in particular we're going to talk about. So companies can face lawsuits, and the question is when to record anticipated expenses and payments. Now, if the payment is probable and can be reasonably estimated, then we're going to record the expense in our financial statements.
Estimable. Fancy word.
Estimable. I don't know if I guess
You don't need to.
I
Reasonably
say it.
estimated is correct. This estimable is a a fancy way to say it.
Yeah, big vocabulary. If payment is probable but can't be reasonably estimated or estimable,
Hey, there you go.
we're going to disclose it in the footnotes. If payment is only reasonably possible, then we are not going to record the expense, but we're going to disclose it in the footnotes. And if the chance of payment is remote, we're not going to do any recording or disclosure at all. So an example to go through, and I do a lot of speaking on ethics as well, and this is a case I've been following for years. Walmart paid bribes to government officials in Mexico in order to help them generate business, basically to open up Walmart stores more quickly.
Yeah, expedite the licensing for the permit process.
Yep, that's very illegal. It's a violation of the Foreign Corrupt Practices Act, and they're subject to fines. So for
Like
many
CPA,
years,
we
they
talked about
disclosed
that
it in their financial statements, but didn't record an expense because they did not know how big the fine was going to be or how likely it was going to be.
And so the U.S. government is leveling the fine.
Yep, I heard one rumor the fine was going to be as high as $5 to $10 billion. No, it ended up their fine was only $283 million, but they couldn't actually reasonably estimate that until this most recent year. So they've disclosed this in the financials for several years, but now in this most recent year, they actually accrued the fine because now they must be reaching some sort of settlement with the government. So in their financial statements this year, they're going to debit some sort of fines or penalty expense, credit fines and penalties payable, and then when they end up paying this off, probably over the next year or two, then they're going to get rid of the payable and credit the cash.
Yeah, and at this level, this example is pretty straightforward, but in actual practice, this gets pretty complicated as far as usually lawyers don't want to try and estimate an amount of a loss, and usually they don't want to say, hey, we're probably going to lose this one. Exactly,
right?
And they're
Yeah.
very sensitive about that. And so this is an actual tricky one in the profession that accountants deal with quite a bit, pretty much around every reporting period.
Exactly. So additional long-term liabilities, there's a concept we saw it on the balance sheets, deferred income taxes. Those are recorded in order to match income tax expense against financial statement income.
It comes up again.
It does. It does. These are just about as complex as any area of accounting, I think, and you'll see those more in an intermediate course or a tax course. There's also pension liabilities. We saw Boeing had some large amounts, and that's just a company. They may promise to pay former employers or retired employees a set amount per month or year for the rest of their lives. They may give them a cash payment. They might also pay health benefits.
Sounds like a great deal.
It used to be really popular, and then companies realized that this is a massive liability they carry. So normally companies provide benefits now that are shorter term. They might match someone's retirement contribution as an example, and then they just make that payment in the current year, and then they're done with it. So as opposed to having some massive pension liabilities on their books. How much did Boeing have?
If you combine the healthcare and the pension plan amount, it's about $22 billion.
Yeah.
$22 billion is what is underfunded because they're putting money into this account to hopefully help it invest and grow, but it's underfunded by about $22 billion right now.
Yeah, so companies aren't doing this a whole lot anymore for current employees or new employees, but it used to be very, very popular. The last really liability that we wanted to get into is notes payable, and this is something we covered in lesson 4. But so we just remember a company may borrow from the bank to fund certain needs, and it would do so with a formal written note. It's going to have a repayment schedule, specific dates and interest rates. And when you borrow, you're going to debit the cash and you're going to credit a notes payable.
Not too bad, right?
Nope, not bad. So let's go through an example. And we'll do a simple one where we don't cross a year end. And now these are normally companies borrow for the long term. We're going to show a couple examples that are less than a year just to keep it a little bit more straightforward. So let's say a company on March 31st borrows 10 grand at a 10% interest rate and has to make payment 6 months later. What are you gonna debit and credit?
Well, I don't have to stress about the mental math at this point because I got the answers up in front of me. But
right.
So initially March 31st, when we actually we borrow the money, I'm going to debit my cash because we're getting 10 grand. I'm going to credit notes payable, not accounts payable, because again, it's a more formal, defined payment period, interest rate, things like that. Then when I actually pay back on September 30th, I'm going to debit the note payable, because I'll pay the cash for that, but I also have to record the interest expense at this point. So I'm going to debit my interest expense for $500, which is the $10,000 that I borrowed times the 10% annual rate, but I didn't have it for an entire year. I only had it for 6 months. So I take 10,000 times the 10% times 6 over 12. And if I add those up, it's going to give me my credit to cash of $10,500.
So that's the more straightforward way. Sometimes notes cross a year end or a period end, and then we have to accrue interest expense. So how about if the same facts, except instead of repaying 6 months after that March 31st borrowing, let's say they're going to pay back a year later. So the first entry is the same.
The same. There's no change in that first one.
How does the second entry change?
Well, December 31st, we've been talking about that matching principle. So we have to record an expense because we've had that benefit of getting the cash. In theory, we've used it to buy inventory or equipment or something.
AJEs, just in journal entries, we've known about these.
So we have to record an interest expense because we've been using it. So we'll debit interest expense for $750 to get that. Took the $10,000 loan times 10% times 9 months.
Now it's 9 months. Yep.
And so debit interest expense, and we're going to credit interest payable because we haven't paid it off yet. Now, when it comes up to March 31st of 2019, where everything is due, we're going to debit the notes payable. Get rid of that. We got to pay the full $10,000 no matter what. We're going to debit our interest payable for $750, and then we only have to debit an extra $250 for interest expense. And to get that, we had already recorded 9 of the 12 months on December 31st, but now we have to record the extra 3 months on March 31st.
This is from like January 1st, 2019 to March 31st, 2019.
Exactly. So January, February, March, and then we're going to credit cash for the total amount of $11,000.
And it balances, and we're happy.
Life is good.
That's right.
We're balanced.
Well, those are liabilities, and now we're just going to introduce the concept. We mainly are introducing the concept of present value because that's going to be useful in tying into our next lesson coming up, lesson 9. We're going to tease you a little.
Actually, we'll talk more about present value stuff in bonds because bonds are long term. Present value doesn't really kick in a 1-year type 90-day note or a 12-month note. But I have a attendance question to ask. How many of you have actually some familiarity with time value of money concepts? Present value, future value, $1 today worth more than $1 tomorrow. Have you taken any courses, be it business math, be it other finance or related courses? In the chat, type a yes, we've done some coverage, or no, don't really know much about it. Please pop in the chat for me, yes or no, to give me an idea. So I saw yes, I'm seeing mostly no's. And again, this is one of our attendance questions for today. So I'm seeing that most of you have not done much with time value of money. And that's okay. That's not going to hurt you, but it'll be a little smoother if you have, but you'll go through this and we'll get some other idea. Coin collecting, no, that's probably futures contracts and value of silver and gold. And if you've got some silver dollars, we should talk. All right, let's keep going.
A little bit with future value. So many transactions involve paying or receiving money in the future. Because companies can earn interest, the theory is that $1 today is worth more than $1 in the future. So for example, you'd rather have $100 today than 1 year from now, because you could take $100 today, and if you could invest it at 1%, you would have $101 a year from now. That's right. Again, an extra dollar is not a lot, but put a few zeros after this, or in periods where interest rates are higher, this makes a big difference.
You give me $1 billion, I'll live off 1%.
You'll live off 1% of the billion,
yes.
$10 million. So
yeah, that'd be okay.
Yeah, you could do it. So, but conversely, a company would rather pay $100 a year from now and not today, because the theory is if they could only get a 1% interest rate, they could set aside $99 today, invest it for a year, and then pay off $100 in a year.
The math doesn't quite add up.
We're off by a penny on that one, so that
we are.
You're gonna let me roll with it just this time.
I am, but the whole idea with that is the present value one. The idea of what does it take today to get that $100 a year from now? That today amount is called the present value.
Exactly. So future value of $1. What the formula is, the current amount multiplied by a factor is going to give you your future value. So let's say you've got a first-year college student. That's a big audience for these. They're 18 years old. What if they set aside $1,000 today and just a one-time $1,000 payment? It's going to grow for 50 years, and let's say it can grow at a 10% interest rate. Well, in order to figure out how much they would have.
It's a long time, but it is realistic.
Yep. In order to figure out how much they would have, what we can do is we can go to a chart right here. These are available online. You would usually do this in Microsoft Excel, but
yeah, we have an Excel series as well. It's where we recommend doing this, but this is a way that gets you the right answer and helps us explain the point for this video.
Yeah. So we've got a lot of factors up here, but in order to identify the proper one, 10% in 50 periods. Whoa!
Did you see that animation?
I did. You did that.
That's pretty cool, man.
I was pretty excited.
But what you see happen here is, to use this chart, we found the rate per period comes over to 10%, and then down on the left side in the column we have the number of periods. We said it was 50 years. So 50 years, 10% all the way down comes out to 117. That's our factor that we're going to use.
Exactly.
That's pretty cool, man.
Great work, man. So then we use that 117.3909 factor, multiply that by the $1,000 investment, and you just put aside $1,000, and you ended up with 117 grand. And that, basically, 117 grand.
10,000, you're a millionaire.
Interest, the power of compounding.
So what if, instead of just doing a one-time thing, I invest $1,000 every single year?
I bet you're gonna end up with more.
You think so?
I think so.
Well, I'm putting in more, so I should, shouldn't I?
That's theory. So let's find out what it's gonna be. So that
we can calculate that. Look at that.
Annuity.
It's almost like you know this is coming.
And that's what an annuity is, everyone.
A series of equal payments is an annuity. So what you do if you're trying to compute the future value of an annuity is what is the amount of these equal payments, multiply it by a factor, and that'll give you the future value of the annuity. So let's say you looked at that previous example, you said, that's cool. I'd like to set aside $1,000 and get $117,000. What if I do this 50 times? Now you can't just multiply that 117,000 on the previous slide times 50, because especially some of your last payments, they're not going to have much time to grow them. So what you need to do then, go to a future value of an ordinary annuity table.
It looks the exact same, just slightly different factors on here.
10%, 50 periods, and now we can see our factor is 1,163.
That's the factor.
That's the factor. So that if we multiply that by our $1,000 annuity payments, we got over $1.1 million. We only put in 50 grand, $51,000 annuity payments, and you've got 1.1 million of interest earned.
I'll take this one.
So hopefully right now, everyone's just like shutting off the video and going to put $1,000 in.
Please just
in the market,
That's
something cheap, not going to cost you a lot of money, no transaction costs.
Exactly.
Let it sit.
This is real. We know why you talk about investing early and investing often.
And yeah, what we talked about before, the companies with the pension plans, now they've gotten away from it, so they're encouraging everyone to invest as much money as early as you can, because it'll grow.
Exactly. So in accounting, we work more with present value factors.
I think they're hooked now, though.
Well, that's why we did it. We did it for the hook. So present value of $1. If you want to figure out a future cash payment that you have to make, what is that worth in today's dollars? You take the future amount multiplied by a factor to get a present value. So let's say a couple expects to pay 30 grand 5 years from now to purchase a new car, but maybe they've got some money today and they just want to set it aside and they think they can earn 6% interest. How much would they have to set aside today?
Yeah, car's still working. They don't want to save anymore. They just want to set it aside. What do they need to get up to 30 grand in 5 years?
Exactly. So in that situation, they said maybe they can invest at a 6% interest rate. We go down to 30 periods and we get, 5 periods, not 30 periods. We get a factor of 0.74726. And we use that factor and multiply it by $30,000 to get a amount that we have to set aside today of a little
Present
over
value
$22,000.
today.
It's not bad.
Not-
I can
it's
pay
better
for that
than
$30,000 car if I put aside the $22,000 today and kind of let it grow.
Yeah, so 30,000 balance, you subtract off the 22 grand we got to invest today, and we would basically earn $7,500 of interest. That would help us make
Like
that payment.
25% of my car is covered just because I invested for it today.
Exactly. You want to take the next one, but if you're going to get a series of payments.
Well, yeah, I do, because, we
This
use
is an
for our
exciting
example,
one. Yeah.
the lottery.
Yeah.
What do you do if you win the lottery, Boz? That's the question.
I don't know what I do because I don't play the lottery, but I give it all to you.
I play. Thank you. I'll take it.
Right.
You heard it here on video. I think that's legally obligated now. Yeah. All right. So present value of an annuity. This is one where you're looking at multiple payments. So it's an annuity, meaning annual, right? We have future annuity payments multiplied by some factor would give us the present value of that. We're looking at what do we need today, what single amount do we need today to create a series of payments down the road. So with our example, if you play and win the Powerball, you have the option of 40.6 million today or 2.37 million per year for the next 30 years, which comes out to 71.1 million. That's the number that they advertise for the Powerball.
Yep.
So using present value, we're going to be able to figure out what should you take, the lump sum or the annuity amount. So here, you believe in appropriate.
Reality is everyone would just take the lump sum. But we'll just show maybe what they should consider.
What they should think about,
right.
yes. I'm taking the lump sum, that's for sure. So if you think you can get a 3.
Actually, I do have a lotto question. If you were to win the lottery today and the present value tables worked out, they're going to play with it and they're going to show you that the present value of one way might be more than the present value of another way. The lump sum might be greater or lesser than the annuity or the payments, the periodic payments or the annuity that goes with that. So I'm going to ask you the question. If you won the lottery today and the numbers balanced, would you take it as a lump sum or would you take it over, say, a 30-year period? So go ahead in the chat. Another question for you. Lump sum or 30-year period? Okay. We're tied. One lump sum, 1 30-year, going once, going twice. Everybody gets to play. 30-year period, lump sum. That way you can invest it. You're in control of it. Lump sum. Okay. Couple more folks, 30-year. And nobody said it depends. That's cool. Because my answer, I would take it over 30 years personally. Most financial advisors would say, take the lump sum. Why? Because they take between 1% and 4% of your total portfolio as an annual fee. Pretty good wage, pretty good earnings. Not bad being a financial planner and helping people. But I know too many, or know of too many. I don't know too many lottery winners. I know I'm not one yet. But the whole point is I know a whole bunch of lottery winners that in 3 years, they take the lump sum and they're broke. They get $50 million. How are you broke in 3 years or 5 years after getting $50 million? Well, you start buying things and then you have family members that you never even knew you had come out of the woodwork and they need help to buy a car and then to buy a house and then to pay for their kids' education. And then they got some medical bills and they have you saying, you're rich, you should be helping us. And they know how to spend your money better than you do. The other side of it is, I know the same thing with NFL players. A lot of sports stars, 3 to 5 years after leaving the profession, are broke. So what's the challenge? I would prefer the steady payout, the 30-year guarantee, because I'm probably more of a risk taker when it comes to investing. But when something like this, I'd say, if I blow a year or two, the year after that, I'll recover. I've got payments coming in. If I buy a nice house, I'm actually going to be able to pay the property taxes and the maintenance and the landscaping and the yard work. And when I have to dig up the lawn or have to dig out the plumbing or replace the electrical, I'll have a cushion to work with. So that's my personal bias, but it is a personal choice. And if you want to be in control and you want to go, it does depend and it does decide on where you want. And it also depends on time, what's your timing, or if you want an estate and a legacy or how that works or how old you might be. So that's your choice, but I just thought I'd share some insights from another perspective because it usually, I will tell you, the people you asked may be biased, and be aware that a financial planner is going to want their cut and they're going to say, take it all, we'll help you make more money. And you might be in a better position to let the government or whoever else pay you on a periodic basis. Food for thought.
% interest rate, what option do you choose? And for this one, we look at similar chart. Notice it's present value of an ordinary annuity, not just a single sum anymore. And through 3%, 30 years, we have a factor of 19.60. So if we look at that factor, again, here's our problem. We see 2.37 million times 19.6 gives us $46.5 million. You can see the answer is choose the annuity option. All right, so What we see here is that if we receive a lump sum, we get $40.6 million. That's the present value of option one, $40.6 million. Well, using our chart and a 3% interest rate, we calculated the present value of all these annuity payments as $46.45 million. So essentially, we took something that's an annuity, what's happening over the next 30 years, and brought it back to what is that worth to us today, one single amount.
Present value.
And so if the appropriate rate is 3%, then yes, we would choose the annuity because that present value is $46 million versus they're offering us a lump sum of $40.6 million.
Now, what it means is getting the big lump sum up front doesn't mean as much to us because interest rates are so low, we couldn't invest it and get very nice returns off it. We can look at how it's different in our next example.
And hey, look at that. Interest rate now is 8%. That's a little bit more realistic. If you invested in the market, S&P traditionally returns 10%, minus 3% for inflation gives you 7% annual return. What do you choose? Well, in this case, we're going to be in the 8% column. Did you see that animation?
That was beautiful, man.
Let's just do it one more time.
I'm very proud of you. Very proud.
Put in the sound too. Yes.
Right.
So we have the 8% animation over 30 years. Now our factor is 11.25. So if we look at this and do the math on the bottom here, 2.37 million times 11.26 gives us 26.68 million. That's not a very high present value. So what we would want to do in this case, take the 40.6 million, invest it on our own, and at an 8% rate, we'll get more money than if we had just taken that annuity.
Well, that in theory means you could take that 40.6, invest it at 8%, and then if you wanted the 2.37 million annuity, take that out, and you'd still have money left over because the interest rate is so high. It's getting a little bit complex. They could learn about that more in
and
future
this
classes.
Is a lot easier too to see when you actually do it in Excel. So watch our Excel video on it.
That's right. So key takeaways from this one, we'll wrap it up. So liabilities, they're recorded when it's probable that a company will need to make a payment or provide the goods and services, and we're, in general, going to be matching them against financial statement income.
Lots of different types. We just got to be aware of the general pattern and then apply it to new types that pop up.
Yep. Second one, the future value of a dollar is worth more than a dollar today just because you can invest that dollar that you get today.
Remember, my $100 turned into $101 at the 1% interest rate.
Yeah. And then present value of future cash flows, that's less than the future amount of that cash flow because once again, you can invest those amounts. I don't know. That's about all I've got today.
Man, this
Okay. Any comments or questions? Any feedback? Thoughts, dreams, ideals, philosophies, goals? All right. We're going to jump into the Excel, and we're going to see a couple other tricks and tips that go with Excel as well.
My favorites. And even though this is more accounting focused, it's okay to do this. It's going to be worth your time.
Absolutely. So we are going to, in our goals, we're going to learn how to use the input cells, lock some cell references, as well as 3 different future value related formulas.
Yeah, so specifically locking the cells on both a PC or a Mac, editing selected cells, calculating future values, payment amounts, and number of periods. Should be a good one.
Oh yeah, let's get right into it here. So we have 3 examples that we're going to go through. Each of those is going to have one of those features Ben just referred to. The first one is investing. So we have a problem that just says, if I invest $5,000 per year at the end of the next 5 years, how much will I have after 5 years, assuming a 7% interest rate? I always like to start at these, Ben, and just say, when we're going to compute an answer, we know it has to be what? Do you know where I'm going with this one?
At least $25,000.
$25,000. Yep. So just keep that in mind whenever you start working with these formulas. We're going to show 2 ways to do this one. One is definitely the slower approach, but it'll just kind of show you how it builds up. And then the second will be the shortcut approach to this. So the beginning amount, what do you think there, Ben? What should I put in this one? So
0. We don't have anything right now. We're going to start at the end of this year.
So if you don't have anything, are you going to earn any interest on it?
I would say no.
We're still going to basically put in a formula so it's ready to go when we do have something there. So in cell B9, we're going to type equals. We're going to link up to the beginning amount. We're going to hit multiply, and we're going to go up to that 7%. And for now, I'm just going to hit enter.
Ooh, I feel like you're setting us up for a change down the road here.
We're teasing. So the total that we're going to have before we make any contribution is still going to be 0 here. It's interesting. I actually hit alt equals, our quick way to sum it up, and you notice that it's also pulling in that year number 1. So I just need to manually change that with an arrow key. All right, and then I will do a shift arrow key to control what I want. My contribution at the end of this year. All right, I've got it shown as a negative $5,000 kind of a cash outflow is what we have going here. So I will link up to that one, link up to that contribution of the negative $5,000. My total then after the contribution, alt equals, and if I sum up the 2 previous cells, my total after the contribution will be a negative 5,000.
All right, let's make one shift, if you don't mind.
Sure.
That negative 5,000, in some ways it makes sense to be negative because this is what you're paying every single year. And when we get down to the shortcut method, we're going to want to have that as a negative to show what we have at the end.
Yep.
But for this example, it makes more sense to look at that contribution as a positive. Think of it as in the cells that you're working at right now. That's like how much we've accumulated. So what I would do is just shift that formula in B11 to say equals negative B4.
That makes sense. And you're going to see below, we refer to the contribution as a negative, and that's why we have the annual amount as a negative 5,000 right here. All right, so we get into year 2, and in cell C8, I will...
0, right? Because that's what it was last time?
Well, we do have a beginning amount, right? At the start of year 1, we didn't have a beginning amount, but at the start of year 2, we actually do. So we link down to B12, and now our interest earned. What do you suppose I should do? I already have my formula in here, huh?
Well, I imagine you should just copy and paste it, and it should work, right?
Absolutely. I did my control.
Wait, you're more of a mental math guy. 5,000 times 7% should be more than 0, right?
Man, what happened in that one? I can look at my formula. C8 times C5. Is that not good anymore?
What happens if you double-click on cell C9?
Double-click on cell C9. Okay, you want me to just go on there and double-click it? All right. I'm bringing up a formula then.
Oh, okay, so taking 5,000 makes sense, but I see that red box popped up, and now it's going to cell C5, which is just nothing. That should really be 7%.
Yeah, it should. So we need to lock down the interest rate. So what I'm going to do is I'm going to go back to cell B9. And it's actually interesting.
The technical term is absolute referencing and relative referencing. they're going to talk about locking cells and locking columns and locking rows, but absolute and relative referencing is a technical term. Whatever term you use, understand that when you copy a formula, it's going to be relative copied unless you put a $ before it, and they'll demonstrate that.
You said double click on it, all right, because that's one of our learning points for today. You can edit by going in here with a double click. The other way you can do it is just by hitting F2, which might just be a little bit quicker.
Definitely is a little faster there.
Yep. And then what you want to do, we're good with the B8 because we want that to carry over, but the B5, I want to hit an F4. We can refer to this as either locking down that cell or anchoring it. Do you prefer one of those versus the others?
You're making that sell money because you see a little $ signs that popped up there.
More money.
And so I've seen this quite a bit in class, actually. You do not hit the little $ signs next to the B, next to the 5. It'll work, but that takes way longer. So just remember this one. F4 if you're on a PC, Command Shift T if you're on a Mac.
Yep. Yeah, so that's why you could type those in. And usually when I'm doing this, I just put both $ signs. It's going to lock down both the B and the 5 as I go to different cells. If I only wanted to lock down the 5, the row, I would hit an F4 again. If I only wanted to lock down the B, the column, I'd hit F4 again. If I decided I didn't want to lock down anything, I could hit F4 again, but it's just easy. I usually just default and I just lock down them both because that serves my purposes. And now when I go to the right with a Control R, you can see I earn some interest.
So if you hit F2 over that 350,
Yeah.
we just get the visual there. Okay, so you see now it is, the beginning amount is moving, from column 1 to column 2, but the interest
See,
rate
it's
is still
gonna
at 7%.
change.
It didn't shift with your formula
See.
because you lock it down.
Yep,
Cool.
absolutely. Now the total before the contribution, I have a formula in there that works, so I can just paste that over with a Control R. My contribution, once again, if I just try to paste this over with a Control R, we can see it's not locked down, so it's trying to feed off of cell C4, and there's nothing there. So what do you suppose I should do, Ben?
I'd go back to cell B11 and then F2 to edit it and then F4 to lock it down.
All right, F4, lock it down. Now when I paste that over with a Control R, it's good. My total after the contribution, I paste that over with a Control R. That is also good.
We more than doubled our investment
We
in
did.
1 year.
We did because of the concept of interest. Now, you can see I was individually doing Control Rs to paste things over. Once I have a model set that I'm good just to kind of run with, now I can grab everything at once. So I'm going to go up to cell C8, hit my Shift Control down. I'm capturing all of that. I'm going to hold down Shift. I'm going to arrow key 3 times to the right, and then I will just hit Control R, and now my whole model is done. So
I think we'd have 28,754. And hey, that's more than 25,000.
So put it this way. What I always like to say with that is there's no guarantee that that's right, but we have a shot at being right at this bottom.
By the way, I want to point out something when you do spreadsheet math. If you look at this answer and you say 28,754, is that reasonable? Does it pass the smell test? Because I've seen people tell me, well, I calculated this out and it came out to $3,754. Well, frankly, 3,754 would be the interest because you put in 5,000 a year. You know the answer is going to be at least 25,000. You're putting in 5,000 a year. If I came up with $128,000 in the calculation, I'd say I put 5,000 a year in for 5 years. I end up with 128,000. Cool. Isn't that great? It would be if it weren't wrong. So you need to look at these numbers and say, do they make sense? Is 3,754 a reasonable number? Is 128,754 a reasonable number? Or is 50,000 a reasonable number? If I put 5,000 a year in for the next 5 years and I calculate and somehow my formula said $52,000, could I double my money in 5 years? And even that doesn't make sense either. This 28,754 does pass the smell test, so it does pass the reasonableness test. And anytime you look at a spreadsheet, look at the numbers. When I looked at ratios in a couple of classes, I said, that number doesn't look quite right. You really can't have 110% of debt to asset ratio unless you have negative equity, which some did, but most don't. So again, the ballpark rules, take a look.
A number had been less than 25 grand, we would have known something was messed up. And what's beautiful about this, and these are the concepts of input cells. There's no Excel shortcut for the input cells. For back in the instructions, we talked about using input cells, but there's no shortcut for it or anything, but we use it so that we can easily change these amounts or rates or whatever you're putting in there to give you different results. So what do you think, Ben? So an interest rate of 7%, do you want to change it? What else can we change it to for fun? So,
10%.
Okay, maybe you're going to be a little bit more aggressive. All right, put in 10%. Now instead of having 28 grand, you have over 30 grand.
It paid off.
Maybe someone wants to be conservative, right? Put in a 3% interest rate. Not as much interest still, some of it. You could also change, sometimes I like to really make things pop with large amounts, and I could change the amounts, change the interest rates. We also have some very large figures there. So I will just pull it back to minus 5,000 and 7%.
Sweet.
All right, now that is the long way to do it. And in the real world, oftentimes your cash flows aren't even every year, so it does make sense to do it. But if you do have even cash flows, you can shortcut it here and using this future value formula. So Ben, just give me the inputs on this one as I go through so I don't have to think. So
Yeah,
rate.
absolutely. Rate was at 7%.
All right.
The number of periods was 5.
All right.
The payment is negative 5,000.
All right.
And keep that one negative because it's like we're paying into this investment vehicle. And our present value is 0 because it's not worth anything to us right now.
So we have our inputs right there. Now we put in the future value calculation equals FV, and I will hit tab to make Ben excited.
I appreciate that. Thank you.
It tells me, and it gives me a little guidance right here. It gives me guidance. It says go up to the right, hit comma, now go up to the number of periods, hit comma, go up to the payment, hit a comma, go to present value, hit a comma. And now the type on this one, you want to address this one for a minute? It says 0 for end of the period, 1 for beginning of the period.
So what happens with this is if you make your contribution at the beginning of the period, say January 1st, you contributed $5,000. That
Annuity
means for
due.
all of that year, you're earning interest on it. So it's like you get an extra period. If you make the contribution at the end of the year, say December
Annuity.
31st, it's still in the same year, but it didn't have any chance to earn interest during that year. And so this problem, it said at the end of the period, which is what we're using. In real life, you could use a 0 or it could be a 1, just really depends on your situation.
Sounds good. So we assumed end of the period here. We put that in, and look at that. We've got a future value that matches within round. Well, it's going to match completely. It's just a rounding issue. I expanded the decimal, and we've got the future values are the same. And
No
then-
way.
Yeah, it's cool.
It must have just been a coincidence.
Coincidence of Excel formulas or whatever you want to say. To Ben's point, he was just chatting about it without getting into it too long, but had we changed it to beginning of the period investing, we put in a 1 right there, we would end up with some more, which I think, and I'm making this up on the fly, but if I put in 5,000 right here and I deleted 5,000 right there, thank goodness that worked. It's always
It
nice when I
all
make up,
matches up.
make up something on the fly. That
Sometimes
works.
you take a risk and it pays off.
$2,000 more
End of
by
the
paying
period,
at the
that's
beginning
just-
rather than the end.
All right, so that's the future value formula. Anything else you
nice.
want to say? Or should we move into retirement and payment?
One of my all-time favorite topics is retirement here.
Well, we love to teach it just because it hooks the students, right? Because when they have long time frames to invest, compound interest really pays off, right?
Exactly. And so in this one, it looks like we're going to be doing the amount to save each year. So you're telling me we're going to figure out, hey, here's how much we want, and Excel's going to be able to tell us, here's what you need to save in order to get to that amount.
That's what, I think that's what we're going to do. That's cool. So someone wants to 30 years from now have $2 million. What do they got to save each year? Assuming a 7% interest rate.
$100
retirement.
per year.
I'm going to guess higher than $100, but I guess there's only one way to find out. So 7% interest rate. The future value amount, I'm going to enter that as a positive because that's a cash flow we're going to receive in the future. I put in 20 million. That was not on purpose. But
I wouldn't mind 20 million. That's fine with
you
me.
could change it, right? But here's an example, right? I put it in, and now I hit F2 to edit it and take one of those zeros out. The time period is going to be 30 years. So now the amount to save each year equals PMT, and it's the first one that pops up, so I'll hit tab. All right, so my rate.
Thank you, boss, for hitting tab there. Appreciate it.
I'm learning from you, man. We learn from each other. So I go to the rate, and I hit on the 7%, and then I'll hit comma. Number of periods, I'll go to the 30s. Present value, do we have anything?
We don't have anything right now. If you did have something saved already for retirement, that's where you'd enter this amount in here, but we don't. So I do a 0, or you can probably just hit another comma as well. Just skip
sure.
that argument.
All right. Yep. So we'll put in the 0 there. The future value amount, 2 million as a positive number. And then once again, it's how much do we want to save? Are we going to assume that we're going to make our contributions at the end of the year? So just put in a 0?
Sure, why not?
Whichever way. It certainly would change the answer. So you just have to decide when you want to do it. So we would have to save 21 grand a year.
And you notice this one is shown as a negative, meaning
Yeah.
you'll have to contribute that amount to a retirement account in order to get to $2 million.
Yeah, so this is a cool one because we teach this in the classroom to oftentimes this is to 18, 19-year-olds, right, who might have 45 years to retirement, so we can go ahead and change this to 45 years. Now look at that, the number becomes much more palatable at that point in time, only about $7 grand per year.
What happens if we go back to 30 for the time period,
Yeah.
and then we change the amount to save each year in that payment formula to making our contributions at the beginning of the year? So put a 1 in there instead of a 0 at the
Well, we
very
know
end.
because we're making it at the
21,
beginning, we're going to
1.
earn interest longer. So the only thing we know is the number has to go down, right? So it used to be, 21,000 and change. Now it's a little under 20 grand. So, yeah, this is an Excel lesson, but finance tip. Invest earlier. You let that interest work for you.
That's a pretty cool one. What else we got?
The last one is, this one's less cool.
Student
We should have
loans.
done
You
this
take
one-
care of this one.
We should have
You take
done
care of
this one first. It ended on retirement. A happier note, but student loans. So it's important, right? So let's say someone has student loans of 50 grand. They're going to pay an interest rate of 6%. How long will it take to pay off the loans if they pay 5,000 per year? So that's what they've run on their budget. All right. Present value. Should we put an amount in for this one then? Would you say?
Probably 50 grand
All right.
because we owe 50 grand.
This is today we're paying, or the student loan balance is as of today, not a future time. All right. The payment amount. What should I do here?
Let's do a negative 5,000 for the payment amount because we have to pay that out of our pockets, a cash outflow.
This would not have worked had we put in 5,000 as a positive number. I'm pretty sure it became a nonsensical result.
Yeah, it wouldn't have worked, and you would notice that right away when you do the formula,
Yeah.
and then it's okay. Something's got to
Totally.
change.
Any future value we can have?
Hopefully 0 because we paid them all off. That's the
Hopefully we
goal
get
here.
rid of those student loans. The interest rate 6%, and then the number of periods equals NP. Ooh, and look at this, I'm not even going to type the whole thing, and I see that it's going to it right now. NPER. I'm going to hit tab right now.
You saved so much time.
I did.
Two
Go up-
letters and an open parentheses.
Absolutely. Go up to the interest rate, comma, go up to the payment, comma, go up to the present value of the 50 grand, comma, go up to the future grand, comma, and we'll say that you're going to make these payments at the end of the year, so that is going to be 0, close parentheses, and it is going to take you 15 years and some change to pay that off. Again, Ben and I are all about making things a little bit cleaner, so I'd probably just hit the comma
100 a month.
one time and 15 years and roughly 9 months.
Cool.
What do you think? You want to take 15 years to pay off your loans, or what do how could you use Excel here?
I don't. Well, what you could do is, what if you mess with that payment input cell a little bit? So let's change the payment to 8,000.
8,000. All right. Wow, 8 years.
We
That's
like
it.
almost
That's
cut it in
roughly
half. Not quite, but pretty
We
close.
didn't even
in
double
half.
the payment, but it cut it in half just because the power of compounding interest that way.
Pretty
Power of
sweet.
interest. Let's just see. Did we cover everything that we wanted to? So we locked the cell reference down. We edited the cells. We learned 3 kind of finance-related functions. Any closing thoughts?
These are some pretty fun functions that we covered today.
Fun.
Yep, fun, depending on your definition of fun. So what do you think? I want to take a quick survey. How many feel that this Ben and Boz stuff has been helpful? I know we covered it in class. I know you covered it in the homework. So give me either a yes, helpful, no, I already done it twice before, I don't need to repeat it, or neutral. Yes, no, or neutral, please. Got a couple of yeses, neutral. Yes. Okay. Yeah. Neutral. Yeah, my gut feel tells me it helps to reinforce. And so with stuff that I know I've lectured on, I know you've read. And no, actually, that's a good question. Excel videos. Let me do a quick survey. Tell me if the Excel videos are of interest, yes or no. No, it depends. Let's do a yes or no on the Excel videos. I know we're not spending a lot of time practicing this stuff, but it does hopefully give you insights on how to use the stuff. Okay. So I'm getting near it looks like unanimous yes on the Excel stuff, because it's really good to see that. I like the examples they use, and I like the application, and I like how it says, okay, I can always go back. You have full access to these videos. So I'm going to actually do another email and remind you where to find them. But these are tools in your toolkit that can remind you of things and help you study for exams as well as the videos. I record all classes, so you have all those videos too. Anything else for today? Anything I can enhance, clear up? Then I want to thank you for your time. Wish you a great weekend and look forward to seeing you on Monday. Take good care. Have a good weekend.
Have a good weekend.
Thank you so much.
Have a good weekend.
Will do. You too, David.
Thanks.